Welcome to Money Matters. I'm Emily Johnson, CFP and Managing Director of Polaris Capital Advisors here in Hilton Head. Look forward to discussing some interesting topics with you today. We're going to be joined by Todd McGarity, the equity portfolio strategist from Polaris, to discuss what's been going on earnings reports wise and where we see the market going from this point out. We're also going to discuss a rather timely topic, credit cards and financial advice for new college entrants. I think this is a timely topic to be addressing right now as a lot of these college students start to take off for their respective universities. So we'll look forward to discussing each of those issues. First, before we get into that, I'd like to talk a little bit about the massive amount of news that has been going on this week. And certainly we could discuss the debt ceiling, we could discuss any number of issues. A lot of that is still in the works. But since this show airs for an entire week, I don't want to get into too many specifics, so we'll kind of give a broad brush of what's been going on, and then we'll get into a couple more specifics with Todd McGarity when he comes on later. So first and foremost, over the last couple of weeks, we've had some great earnings reports coming forward. About 75% of the companies that reported did report positive earnings results, so that's been very strong for the market. But in spite of that, we've actually had a lot of negative economic news, of course, also coupled with what's been going on with the debt ceiling, and a lot of negative news coming out of Europe with regards to their debt issues and trying to resolve those issues in places like, well, for example, Greece, Italy, Portugal, and Spain. So in spite of our strong earnings reports that we've been having because of the negative economic news, slow ISM data, slow earnings data, some weak consumer information. Because of all of that coming together, we've seen a pretty negative run in the markets for the last several days. So we're going to discuss that in greater detail with Todd and discuss how it is that you might position your portfolio going forward based on that information. And then we'll get into a little bit of news and financial advice for college-bound students. So look forward to discussing that with you here in just a minute. And next is David Crowell with the Mortgage Minute. We'll see you here shortly.
Hello, this is David Crowell, and this is the Mortgage Minute. Today I'd like to talk about the debt ceiling, the deficit crisis, and the impact on interest rates. From a couple of my previous minutes, you'll remember that bad news almost always causes the bond markets to go up and interest rates to come down. Well, we've had a lot of bad news. We've had a government that can't make up its mind about basic housekeeping, and we have no real answers to deficit spending, and we have an economy that remains in the tank. All of these are bad news items. All of these have the very positive consequence of lower and lower interest rates. Over the last several days, rates have come down significantly. The basics of the economy are as follows. If you have a loan to refinance, you must do it now. It's back to a 40-year low in interest rates. If you are contemplating the purchase of a property, there is literally no better time ever to do it than now. We are witnessing one of those strange periods in which there are multiple sources of bad news, all of which make rates go lower. So keep your eye on it, get your confidence back, and either refinance or purchase, whichever is to your personal plan. Do it now. Thank you.
Welcome back to Money Matters. I'm Emily Johnson, and I'm joined by Todd McGarity, the equity portfolio strategist for Polaris. And Todd, when I opened the show, I talked a little bit about what's been going on as far as economic data that's been coming down the pike. Of course, we have the debt situation that's going on in Washington, debt situation over in Europe, just lots of information. This is a very busy week, as have the last couple of weeks, I suppose, been. But let's get started talking a little bit about the personal income and personal spending reports that came out relatively soft this week. What does that say about the consumer, and is that a concern?
It is a concern. I think more than anything, it says that the consumer is deleveraging. Given the economic events that have happened in the past 2 years, it really is an overdue thing. So I think deleveraging in the long term will be good for the economy. But right now it's causing some near-term pain and a little bit of uncertainty as far as visibility for corporate earnings. So we're starting to see a little softness in this quarter.
It's somewhat interesting that the consumer is deleveraging, but our government isn't. They're okay raising the debt limit, but we're actually trying to pay down our credit cards, and we're taking the short-term pain, for hopefully for the longer-term gain as consumers.
Well, I think you could see that the market is not really happy with this new debt ceiling, agreement, and that is the main reason. Why do you think that is? I think the main reason is, it views it as kicking the can down the road a little bit again. So that creates a little near-term uncertainty. And that's something that CEOs really don't like to see. It's kind of a cloud that hangs over the market and really prohibits any sort of visibility in the third and fourth quarter, which I think a lot of people were expecting we would have a little bit of a rebound in the third and fourth quarter. So.
Well, I know when we were looking at, in the first quarter looking forward, the thought was that, sort of Q3, Q4, that was when we were going to see perhaps interest rates go up. We were going to see that the market was probably going to go up, and that was what was going to drive the interest rates going up. And now, today they were even talking about possibly having a quantitative easing 3. Right. Which I think that's probably one of the reasons why, again, the market's diving.
I think a QE3 would be hugely unpopular, by the market standards. So I don't think we're going to see that. I do think we're going to see a little bit of a pickup in the third and fourth quarter. And I do think rates on the long end of the curve do have to go up. There's really no place else for them to go. In the short duration of interest rates, or in the bond markets, short duration.
Short duration sort of being, just for definition, sort of 3-4 years.
Exactly, the short maturities. We really have a negative real interest rate. By the time you factor in inflation, we really have rates at about 0. So that's brought the long end of the curve artificially low.
And when you say long end, we're sort of looking at the 20, 30-year treasuries is what you're looking at there.
That's right. That has traditionally been a safe haven. Treasuries are traditionally a safe haven for money that comes out of equities and looks to hide in the bond market. So that money has been moving pretty steadily, but we believe that's a little bit of an artificial move with the wrap up of the latest quantitative easing. It's kept rates in the short term artificially low, so that's brought the long end of the curve fairly low, and we feel like that's got to move up. So
there was actually an interesting comment on CNBC this morning that was saying that they were seeing, over the last month or so, they were seeing a good bit of money moving out of treasuries and moving into emerging markets debt. I thought that was somewhat telling, that people are saying, this rate for the risk that we're taking is just not worth it anymore. I'm not sure treasuries are the place to be, and not just necessarily flying to commodities and gold, et cetera, but to emerging markets.
Emerging market debt is, from an interest rate standpoint, is attractive to, I think, some players in the market, but for the most part, emerging market debt is very risky right now, given the Europe situation. It's not something we would tread into.
Right. So. Well, it's like the other thing that they said this morning. My favorite comment this morning was something along the lines of, eventually you can't just win by being the better of the worst, or something along those lines.
That's right.
So eventually we have to correct our.
The U.S. Treasury market still remains the bellwether. It remains the safe haven worldwide, and I think that's becoming, with the European situation, I think it's becoming more and more so the case. So. There's been a lot of talk about us losing our AAA rating, and the reason the bond market really hasn't sold off based on that possibility of a downgrade is we are still the safest place
we're the
out there.
best of the worst.
It really doesn't matter whether you call it AA or AAA, given what's going on in emerging market debt and European debt specifically. We still are the safe haven.
So, that lack of visibility and the uncertainty, that doesn't just play into, company CEOs' minds. I'm sure that plays into your mind, too, as you're managing an equity portfolio, sort of trying to navigate through, what has it been now, 9 negative days and all of the noise. And it's not just white noise anymore. This is a lot of historic, stuff that's going on at this point. So, how are you positioning the portfolio going forward, your equity portfolio and ETFs, et cetera, going forward as you look towards the third quarter, based on this massive, or this lack of certainty and this massive information coming down the pike?
Well, I think given current market conditions, we continue to tread, pretty carefully out there. There are a couple of focus sectors, as you know, that we've talked about previously that we're concentrated on. Primarily energy is one that tends to be, somewhat, I guess, averse to some market risk.
Was that largely because people they can't necessarily control their energy spending? They're still going to have their AC on. They're still going to have to drive to work, and
to a large degree, it is a consumer non-discretionary type expense. So that's
and then
exactly.
You factor OPEC into it, and
right. You factor OPEC and the rising cost of oil. There's a lot of integrated oils that we're participating in, natural gas producers. Things along those lines that provide, not only a high dividend but a high degree of safety. They're earning a lot of money right now, so that's a good place to park money right now.
So energy is a good spot. What other sectors would you suggest?
We are starting to look at some of the banks. A lot of them are trading below book value right now. There's always a question of what book value is.
Right, of course,
so,
especially with all the mortgage write-downs, et cetera.
Exactly. So we do think the banks offer particular value right now, but we are participating, in the way of an ETF.
And the types of banks that you're looking at, are you looking more at retail type banks, or are you looking more at investment banks?
Well, we're looking at investment banks individually.
Specifically because?
Specifically because of the exposure to the mortgage market and the retail consumer that the large banks have, the retail banks. So primarily, in the investment banking, we're owning individual stocks,
so
individual names such as, Morgan Stanley, Goldman Sachs.
Okay.
Those are trading at historically low values. So those are the ones we concentrate on. Individual names. The regional banks still hold a lot of risk, but we do think there's a lot of value there, so we're participating in those via ETF.
Okay, such as FAS, I think is one we've talked about before. And okay, and then are there any other sectors right now that you think are strong that would be worthy of a second look?
We think certain sectors or certain sections of technology.
Really? Even though the NASDAQ is taking a whack?
Yeah, you got to be very selective, and I think specific technology, the smartphone move continues to gain momentum, and we feel like that is...
the iPhone 5 now?
Right, right.
Amazing.
So, Apple, Google, not only the iPhone, but the Android move, we continue to be focused there, technology. We're not going much outside of that space or to the chip equipment or any of that quite yet. We are dipping our toe there a little bit, but we feel like there's a little bit of softness in the PC cycle, but the smartphone move continues to gain momentum with the iPhone and also through the Android phone.
So you're looking probably not just at Apple and Google themselves, but also suppliers for those?
Exactly. Yeah. Apple and Google, their core holdings, generally we're finding more value in suppliers to that food chain.
Okay.
The Broadcoms, people who supply chips and things of the sort to build the iPhone.
Well, that's great. Well, thank you very much for giving me all that information, giving us all that information. I appreciate it, and I know that with all of this uncertainty, it's probably harrowing to come in here and try to make some prognostications about where everything is going. But I really appreciate it, and we'll have you back in a couple of weeks to discuss it again based on what comes down the pike. So thank you very much. I'm Emily Johnson. This is Money Matters, and we will be back in just a minute to discuss financial advice for college-bound students. Hopefully they can take some of this with them to the university, and look forward to seeing you in just a minute. Welcome back to Money Matters. I'm Emily Johnson, and I want to discuss a little bit about a very timely topic for all the students that are heading to college right now, and that is financial advice for the new college-bound student. This is something that we read a lot about, and it's certainly something that I wish I had read more about before I went to college and had some of this advice, or I was probably given some of this advice and didn't listen when I went to college, I'm guessing. But we polled some of our clients, we polled family friends, and did plenty of reading in popular literature to try to come up with the top 5 pieces of financial advice that we would give college-bound students. So the first piece of advice that we would suggest is learn to budget. And while budget is certainly a four-letter word for most of us, learning how to do it early and doing it on a regular basis, on a monthly basis, is imperative. It's very imperative for college students who are going to be, for the first time, living on a budget, and they don't just necessarily have money coming from mom and dad in the form of a credit card or a debit card. So some big aspects to think about when it comes to budgeting. First, always think about what your resources are before what your expenses are. So you can't necessarily look at what you would like your lifestyle to be in college and then define the revenue around it. Unfortunately, usually your revenue or your monthly check that's going to be coming in is going to be fixed, and you need to live within that fixed amount. So always, plan for your expenses to fit within your budget, so-called live within your means, as we always, as all of our parents always tell us. And then second, on a monthly basis, look at your fixed expenses first and your discretionary expenses second. So fixed expenses are going to be your rent, food costs, maybe the university meal plan, parking expenses, car insurance, whatever the expenses are that are necessary for you to maintain your health, shelter, etc., so that you can then go on and do the best that you possibly can in school. Everything as far as saving for spring break and the trip to the river, that's going to come second. Unfortunately, the sorority t-shirts come second. But make sure that you plan for your fixed expenses first, discretionary expenses second. And if you see that there's going to be a gap that's there, that you're going to need some extra revenue, then certainly we're going to address that in some of the future topics. But if you see that there's a gap there, then look at what that gap's going to be and try to figure out what it is that you're going to need in order to have the lifestyle that you want in college. But number one, first and foremost, is learn to budget, learn to save for those future expenses, and make sure that you consider what your fixed expenses are versus your discretionary, and do it on a monthly basis. So as exciting as that is, that's number one. I know it's not the most fun topic, but it's essential for a healthy college career. Number two, avoid bad credit card debt. This is something that you hear all the time. Credit card debt is what's called non-productive debt. You've already enjoyed it. You're not going to like paying it back in the future. Nobody does. I don't think many people usually get a positive feeling from their credit card debt, even if they have great air miles that come with it. So avoid all of the kiosks, all of the tables where they give out free t-shirts, college mascots that are stuffed animals. Avoid all of those. Those banks are there to make money off of you. They're not there to benefit you. And as great as it might be to have a credit card in your own name, definitely don't just apply hara-kiri, because it will impact your credit report every time that you apply, which is going to become more important as the years roll on. And most importantly, if you're actually using those credit cards, chances are they're going to be high interest credit cards, and those are going to be a negative when you graduate and you get that first job. You do not want to be saddled with all of that credit card debt upon graduation. Chances are, and a lot of the statistics are showing, you're going to have school-related debt. That's productive debt. Great. You can take pride in paying that back over the next few years. It's productive. Credit card debt is not productive. So have one credit card at most for emergency purposes. It also helps to build your credit report if you're paying it back on a monthly basis. And then the last thing is, consider having a debit card where you get an ATM or where there's ATM fees that are going to be refunded to you, or at least at the very minimum where you have ATMs that are close to where you need them to be. So if you live in Hilton Head and you're going to college up in New York, don't necessarily want to look at just local banks. You might want to look at, say, a national bank, so that you make sure that you have an ATM that's going to be close to you, so you're not paying $2, $3 in credit card, in ATM fees on a regular basis. It adds up. Third, visit the Career Center for your college. In large universities, sometimes there's a Career Center for the university and also one for your major. Go to that Career Center frequently for multiple reasons, but the first one, sometimes there are scholarships that are specific to that major. Go to that college, go to that Career Center within that college, and ask them if there are any scholarships, any grants, any work or internship opportunities specifically for that major. It will help you. It will hopefully provide some financial support in the future, and frequently they're not as published as, say, the larger scholarships are. The other thing there is consider work study that might be listed within that Career Center. Chances are, you'll make a few extra dollars, nothing necessarily to write home about, but it might be that discretionary income that you're going to want in the future, and it will help you to hopefully gain job opportunities in the future. Number four, find savings opportunities on campus. There's lots of free entertainment on campus. Meal plans are usually less expensive or subsidized on campus. Take advantage of those, the university gym versus an outside gym. Lots of great opportunities for free extracurricular activities on campus, and certainly buy used textbooks as opposed to new textbooks. That's going to be a tremendous savings. And then lastly, number five, our last piece of advice for college-bound students, and this does not sound like fun either, but I did it and I would highly recommend this one. Take at least one personal finance class and at least one basics of accounting class. You won't love the class necessarily unless you're of course a business major, but you'll be really glad that you took that class, and I would strongly recommend it. I think that most folks would say that they wish that they had done that when they were in college. So there's our top 5 pieces of financial advice for college-bound students. I hope that it's been helpful. And we're going to need to take a quick commercial break, and we will be back in just a minute with a closing and a little bit of advice for the parents of college-bound students. So look forward to seeing you in just a minute. This is Money Matters. Welcome back to Money Matters. I'm Emily Johnson, and I'd like to close with just a few parting shots. First, we had Todd McGarity on discussing positioning your portfolio. Quick things to look at there: financials, technology, energy. Make sure that your portfolio is positioned adequately there. Those might be some places that you can invest some cash right now that we're looking forward to growth over the next quarter. And then a few suggestions for the parents of college-bound students, and this is our last closing point. 2 suggestions. Number 1, meet with your financial advisor before your child goes to college and make sure that you're looking at what your cash flows are for financing your child's college education. Do you have a 529 plan? Is now the time to use those funds? Have you applied for student loans? Have you looked at PLUS loans? Those are the loans for parents. Is this a good time to do that? What are the interest rates on those right now? You know, chances are college is going to be more expensive than any of us would have anticipated. And so make sure that you're looking at what your cash flows are, what your savings rate has been, and what your personal and the rest of your family's needs are going to be, to make sure that you're matching those expenses with your resources in a way that doesn't pinch too much and takes advantage of a lot of the opportunities for low interest loans that are out there if necessary, and also any savings that you've done in the past. And second, discuss your expectations for assisting with your child financially during school with your child. Talk about what their budget should be. Talk about what your expectations are, what their discretionary expenses can be, whether or not they might need to get a job. Discuss that with them. Don't leave it up in the air to potentially fuel uncertainty and fights in the future. Give them that certainty, let them know what the expectations are, and then let them grow from there. So those are my 2 sort of parting shots, pieces of financial advice for parents of college-bound students. I hope that it's helpful. So that's it for us today. Thank you for joining us on Money Matters. We look forward to seeing you next week. And please, if you have any ideas for topics, anything that you'd like to see discussed on future shows, please check us out on Facebook. Please email us. Email me at emily@polariscapitaladvisors.com. We welcome your ideas. We really look forward to answering your questions and hearing your thoughts. So look forward to seeing you next week. This is Money Matters, and I'm Emily Johnson. Have a great week.